What's going on, everybody, and welcome on into the TC Trading channel. So reducing risk with a credit spread options trading strategy. In this video, we're going to be talking about credit spreads, how you can profit from them, how you can reduce your risk, and then of course a live example of us actually in a credit spread, and we're going to look to close that out here in our Webull platform. So make sure you stay in tune. We'll leave timestamps down below to different parts of the video. We'll first talk about how this stuff works, and then we'll dive into the examples. And we currently have a call credit spread on right now that we're going to actually look to close out and show you how to do that and why I probably shouldn't close it out. But for the purpose of this video, I wanted to close it out so you can see how it works on the platform. So real quick, we're going to look at optionsbro.com as our place to easily visualize this example. In the last video that we did, we talked about debit spreads, okay? I would highly recommend you go back and watch that video talking about debit spreads. It's a different way to trade option spreads, reduce your risk, but also put yourself in a higher probability trade. And why we say that is because we're capitalizing on what we call theta decay, okay? So that's when you're in an option contract and the stock's not moving or it's moving against you, and not only are you being hurt from the stock moving against you or not moving, you're getting hurt by the time decay, the theta decay, because each day that option, right, each day that goes by, that option is losing some value, and that's called theta decay. But with credit spreads, with debit spreads, we don't have to worry about that, so we can take advantage of not losing value based on theta decay. So I wanted to use optionsbro.com to visualize this example, and I think it's the easiest place to do it. The reason why I'm using this now in this video is because the last video, I tried to draw it out, and I think it was helpful, but it took a little bit longer than we probably needed to spend on that video, okay? So really quick, there's two different types of credit spreads. We can go the call credit spread and then the put credit spread. Now, it's actually kind of reverse of what you may think. When we're trading a call credit spread, we're actually bearish on the stock. We want the stock to either sit where it's at or go lower. And when we're trading a put credit spread, we're bullish on the stock. We want that stock to either sit where it's at or go higher. And we'll talk about what strike prices you can kind of look at and then our example here. So here is the call credit spread. So when we're talking a call credit spread, we're talking about calls. You're going to be buying a call and selling a call. And because it's a credit spread, you're going to be getting a net credit. So the call that you sell is going to be worth more than the premium of the call that you buy, okay? And why may that be the case? Well, take a look at this example, okay? Let's pretend that the stock is trading right in the middle here, right around this break-even point. We're going to short a call here, and we're going to go long a call here, okay? Now, what call is going to have a higher value? Well, the call to the left, right, which would be the call that is below the current trading price of the stock, is going to have more intrinsic value. It's going to be in the money based on that example that we're looking at, which is very similar to the example I'm going to show you guys with Webull when we dive into that in just 1 second, okay? So in this case, right, this call is going to be higher value. We're going to sell it by shorting it. Shorting a call means we're selling a call. And we're going to go long a call here that is going to be a little bit out of the money in this example. And that call is going to cost us less to buy. This leaves us with a net credit to our account. So we're actually going to get paid for this. And then depending upon how this stock plays out by the expiration of these two options, it'll determine our max loss or our max profit. But what you need to understand for our max loss, if the stock is trading above the long call, if our stock is trading higher than the long call, which would be higher than both strike prices that we messed with right here, higher than the one we sold and higher than the one we bought, that's our max loss, okay? That's what it's going to be. That's when we hit our max loss. That's how you get there, okay? In between, if the stock is trading in between the short call and the long call, that's where the lines get blurred, and that's where we don't hit the max loss. You could be green, you could be red, depending upon your break-even point, which will show better in our example. And our max profit is if the stock ends up expiring, right? The expiration date hits on these options, and the stock is trading lower than the short call that we had. Why does that make sense? Well, that would mean that both of these calls would expire worthless, which would mean that what we got as a credit is our max profit. So let's say, for example, right here, we sold this and we got a $1 credit back in the account, which is equal to $100 in option world per one contract, right? So let's say We sold one contract, bought one contract. We're going to get $100. The stock ends up expiring below where this was setting up, and we end up with keeping that $100 and we move on with our day, and it is what it is. The only problem here is if the stock starts to expire or the stock expires above where we shorted the call and below where we went long the call, that's where we start having to worry about the break-even point, and it will depend based on the premium you paid and the different strike prices, which we're going to talk about here in just 1 second. Take a screenshot, go to optionsbro.com. I'm not associated with them by any means, but I wanted to use them as an example and give them the credit here because they put it together very nice. I think this visually was a great way to explain things. But the great thing about credit spreads is that you're going to know your max loss and your max profit going in, so you don't have to necessarily worry about this option going crazy and having to worry about when do I take profits or the option just going down, 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 and when do I cut a loss. You know that going in, and so you can make that determination before you even buy this spread. So right now we're over on Webull right now, okay? And we can see a vertical spread right here. So what I want to show you guys is that we did this on Lucid for the time being as I make this video. I want to go to the option chain really quick, and I will zoom in on this so you guys can see the option chain. But what do we have right here? What I did was I actually sold a $25 call, and then I bought a $29 call. That was the option. That was the spread that I played, the call credit spread play, which is essentially bearish. I am bearish on Lucid. I expect Lucid to pull back, which we actually got. So I'm currently green on this spread. I go into my account and here it is. It's going to be these three pieces right here. And as we can see, my unrealized P&L right now is roughly it was bouncing around between $6 and $8. So I just put this on. If I let this thing kind of expire out or go through the rest of the week, then I could potentially make more. However, right now we can see that I'm up a few dollars on this spread. But how do we get to that point? What you're going to want to do is you're going to want to go to the option chain and you're going to want to go to vertical up in the top left, okay? Then what I'm going to do is I'm going to just click on one of these options and I'm going to click on buy. Now I can go ahead here and look at the different strike prices and make my determination as I see fit. First, you have to start off by clicking sell on the top, because ultimately here we're looking at a credit spread, so we want to be selling the first leg and we want to actually be selling on the call side. We want to be selling the lower strike price option, okay, in this example, okay? So I'm going to actually move this over, and so we can see it a little better. I'm going to zoom in, and I'm going to go to the graph here. This is the best way to look at things. I'm telling you guys, the graph is awesome. Okay, so let me make this nice and big for us here so we can see this. And now what I've done is I've actually gone into the exact option spread, the credit spread that I am in right now. So I had a width of 4 here. You can change this width, and that's just going to be the difference between the call that you're going to sell and the call that you're going to buy, which that's what you can mess around with on your own. And then what I did was I moved the strike prices up around. So what I'm looking at right now is I roughly in my head was calculating, I think Lucid could end the week below 25. That's where I put this sell that I had. I want to sell the $25 calls because I believe Lucid will end up below. And if Lucid expires below the call that I sold, that's where I hit max profit. And so we can see that here below 25, at 25 or lower, we have max profit. This profit does not go up or down. It's at $128 and that's it. I have it set to one contract and expiring at the end of this week. It's currently Tuesday when I'm filming this video. Now, in terms of my max loss, we can easily see that right here by if Lucid expires over the contract that I bought. So if Lucid expires over $29, I have my max loss, which happens to be $273 or so, or $272 in this example. Then, as I scroll between that 29 and 25, I can start to see where this turns to a break-even point. In this example, our break-even point is roughly at 26.27. Why is that the case? Well, our break-even point is going to be calculated by taking the contract that we sold and adding the premium. So right now, our limit price is our option premium, okay? Our limit price right here is $128 for this spread. I can adjust that, and that could change depending upon if I'm waiting too long to enter this and whatnot. So I'd always make sure before you enter, make sure you haven't wasted too much time. Make sure the stock is still trading where it was, or you have to potentially adjust this limit price. So what I'm looking at right now is my limit, my break-even point is going to be this 25 plus 128, which puts me here at just roughly 26.28 would be my break even point on this option. So if Lucid ends up around that point come the expiration, come Friday, I'm going to have to get out of this for break even. But the way we want this to play out is we want this to expire worthless. We want both of these options to expire worthless, and we want to keep the premium that we ended up selling. We want to keep that premium of Lucid, that 128 that we're going to sell this for, and get that credit right here at the bottom. It says estimated premium credit 128, and our max loss is this 272 with our max profit of 128. Now you may think, okay, risk reward here is not great, but the stock is currently trading just under $27, and it's been up quite a bit this past week. So I'm looking for it to come back down and cool off, maybe around $24 or so, maybe $25, and I would still end up green on this trade. So this is the example that we're looking at right now of a credit spread on the call side, okay, where we are selling a call that is lower than the call we buy. So our sell is a call that is less in terms of the strike price than the call that we buy. And in this process, that call is more expensive that we sold. So we're going to net a credit into our account. And we are expecting, best case scenario, we want this stock to close the week or close by the expiration date of this option, right? We want the stock to close below the lower strike price, and we don't have to necessarily do anything. We could close it out. We don't have to. We don't have to do anything here in this case because we'll hit our max profit. Both of those contracts will expire worthless, and we got paid to take this position. And once they both expire worthless, there's nothing we have to do on our end. But on the other side, if it goes against us, we may have to get out of this position either at the max loss, or we could get out of this position a little bit earlier so we don't have to hit that max loss if we don't think it's going to go our way before the expiration. So for example, guys, now that I'm in this given position right now, take a look at this. We're looking at Lucid right here. We're actually now down on this given position. So I'm looking at Lucid. If I want to get out of this position, I'm going to go right here and close my Lucid vertical. Okay, so in this case, I'm going to have to put a limit price as to where I believe I want to sell this vertical, which is going to sell both, where we're going to get me out of both of my positions. It's going to close both positions essentially with one click here. So I'm going to set the limit price at this 138 and click on place order. Boom, just like that. And it has filled. I just got the notification. It is no longer in my position list. And there we go. That is how you close it out. Pretty straightforward. Webull is going to take care of all the hard work, but you have to make sure in this situation you are playing with options that are liquid. For example, Lucid right now, look at these options. Look at the open interest on these options. There is quite a bit of open interest. If I'm looking at these options back here, for example, the $10, $11 calls, there's 2 open interests. I don't want to mess with anything that's less than a couple hundred open interests. Ideally, over 100 is okay. But I honestly want to see something that's trading where you have multiple hundred open interest, at least on the option chain. Now, opposite side, it's the exact opposite for a put side. So if we're doing a put credit spread, we actually want the stock to go up. And in this case, we are shorting a put, selling a put that is higher than the put that we are going long. In this case, let's again assume the stock is trading right here at the break-even point as we speak right now. We're going to go short this put. That put right now would be above the current trading price of the stock. That put would be in the money, as we say, and have a higher value than this put right here, which would be out of the money, trading below, or actually the strike price is below where the current stock price is. So that stock price would need to drop below this long put strike price for that put to get into money and for us to hit our max loss. So again, on the put credit spread side, the max loss is if the stock is trading lower than the put that we went long, and the max profit is when we are trading higher than the put that we went short. And our break-even point is in between. To calculate that break-even point on the put credit spread, what you look at right here is you'll want to take the strike price that you went short, and then you're going to want to subtract the premium that you got paid for putting on this position. That will give you your break-even price. And then, of course, if the stock is above that break-even price, you're going to make money. Below that price, you're going to lose money. So again, on the put side, you are bullish and you want the stock to go higher and ultimately be above the short put that you sold, the put that you sold for you to achieve your max profit on this position. Now, the reason why we like to play this is because we're going to be taking advantage of not having to worry about time decay and theta decay, right? And so by doing this, we don't have to worry about theta decay on our options. All we have to really worry about is our price points. Is it above our break even? Is it above our max profit? And that's it. That's all we really have to worry about when it comes to these credit spreads. So hopefully this video was helpful. Leave us a comment down below, any questions, thoughts you have. We'll also recommend that video on debit spreads. Go back to the option playlist or just go back to the last video. That video will be on debit spreads. We talk about that. We do some examples on the iPads. Hopefully that is helpful. Again, we can make more videos on stuff like this, but hopefully that example of kind of getting out of that position was helpful. Thank you guys so much, and we'll see you guys in a future video. Any links, resources to free stocks, Webull, all in the description box down below. Peace.